Good. Let's kick off this iPredict panel. I have Tim Nguyen with me. He is the co-founder and CEO at Be Smarty, and Brett Chandler. He is the founder and CEO at FormFree. And my name is Shashank Shekhar. I'm the founder and CEO at InstaMortgage. So I wanted to start with, this is supposed to be a panel discussing machine learning, predictive analytics, artificial intelligence, all of that stuff.
Crazy stuff.
Crazy stuff. I wanted to kind of just set the stage by talking a little bit about machine learning, and then we'll get our panelists to define predictive analytics and some of the real life cases that they are working on, and what the industry could be working on with predictive analytics and machine learning. But really, when you think about machine learning, it's probably precursor to what artificial intelligence is. You're trying to train your machine into learning something and then be able to recognize either speech or text or image and be able to make a decision from this. One of the easiest examples that I like to give is that if you want your machine to learn that a certain picture that you're inputting is of a cat, then you'll have to do that hundreds and thousands of times for it to recognize what a cat looks like. But you'll also have to do hundreds and thousands of times is to feed it pictures that looks like a cat, but it's not exactly a cat, for the machine to figure out, okay, this is what exactly cat is, and this is what a cat is not. But if you're not doing it adequately, meaning that if you don't have enough pictures that you're feeding into it, or if you're not doing it accurately, meaning that it's not getting the information it's supposed to, then when it's making a decision, that's when all the decisions are not correct. That's why we see, for example, ChatGPT making mistakes or other artificial intelligence tools making mistakes, is because sometimes it's not adequately trained and sometimes it's not accurately trained. So this just wanted to set the stage of what machine learning is as the panelists get into the discussion. But Tim, let's start with you, and let's get into predictive analytics first, and get both of you to kind of define for the audience is, if somebody has barely heard of predictive analytics, maybe they think they're not using it, how do you define it?
So predictive analytics is, put simply, is using data of the past to predict the future. And if you really think about it, us as humans, we've been doing this forever. I have a sweater on today because when I left the house, it was gloomy, so it might be kind of cold. That is predictive analytics. It's just using history to predict the future. Of course, that's a really simple example. Computers can help us predict the future better. It can factor in the time of the week, a weather storm, 300 miles away from here. It can help us predict the future better. So that's really all predictive analytics is. And I would also argue, right, everyone in this room is using predictive analytics in your business today. Fannie Mae DU, it is predictive analytics. It's probably a very complex decision tree with regression. We don't know the inner workings of it, but you've been using those systems all day long, every day in the course of business. So predictive analytics is simple. It's taking data, analyzing that data, running models against that data, and then you have to deploy it and monitor it. I think that's one of the critical points, is monitoring the data, or monitoring the outcomes of the analytics, and retraining it for drift, retraining for shift in markets, and just overall extremities and exceptions.
Brent, what's your take on that?
Yeah, I would liken it to the human as well. Pattern recognition, we identify patterns and follow those patterns and adjust accordingly. And so I think the use of science and mathematics and pattern recognition truly is evolving with the capabilities of speed and the corpus of data. Predictive analytics today is so exciting because there's so much data that we can look at, and there's so many patterns we can begin to recognize. And as an industry, it's all about historical, right? If we think about how do we predict a consumer? How do we predict the behavior of a consumer? Well, typically we look back in time, and we look at performance based on, have they paid their bills on time? Have they taken debt and been good stewards of that debt by paying it? And that's the predictive nature that we've applied as we look at giving future loans. And I think with new data, predictive analytics can open up a brand new world of how we assess those patterns. Like real-time data being accessible on such large thresholds of information spanning all of our activity can now be a better determinant of what we're going to do in the future. So predictive analytics can forecast behaviors, patterns, and distress in different ways, in new ways. And to the point earlier, the applications that we're using today are doing it to a degree, but as the data expands, we can do more.
Yeah, and as you guys rightly pointed out, predictive analytics is there in practically every tool that we are using in some way or the other. I mean, Uber is using predictive analytics to tell you how many minutes it will take. Even before they confirm the driver, they are saying it could be 5 minutes out. Your ETA will be 11:05 a.m. And that's using predictive analytics to do that. But I think, Brent, you touched upon something really interesting, the fact that it's not just in the future that we are talking about. Of course, it's the future that we are trying to predict, but a lot of it comes from the past. You're looking at the pattern of data from the past. And the good thing about predictive analytics is you can actually go in the past and test if your hypothesis works. So you can go 12 months back and saying, okay, I mean, Brent is saying that this data should perform like this. Let's go 12 months back and see in the past if this data actually performed like it or not, which is the cool part about predictive analytics. Tim, what do you see some of the things that we are already using? You mentioned about DULP, AUS. I sometimes jokingly say that Fannie Freddie are probably the best fintechs in the country because they have been doing it for a long time, and it's something that everybody uses.
And they have the biggest corpuses of data.
Yep.
But tell me some of the other use cases that you see right now. We're not even talking about the future with predictive analytics.
Yeah, I mean, if you look across mortgage, credit report is the building blocks of predictive analytics. That's run in every application, right? Whether it's soft or hard or whatever. Fraud, KYC, right? Predicting someone's name, social, date of birth. What's the chances of fraud? If I do this loan, am I going to waste my time? Lead scoring is another place. Which borrower do I serve first? Document collection, we're starting to see that come out to drive more effective behavior. You manage a team of processors, you got 300 uploads that came in the last 2.5 hours. Well, which ones do you look at first? Which ones do you classify first? Right? Predictive analytics will help you understand which ones needs to go first so that you could drive the correct behaviors to maximize efficiencies. I do think with the advent of AI and how things are getting very powerful, I think the traveling salesman person will finally be solved. We'll see. Right? But this new data set, these new technologies, is taking something that's very natural to us as humans and just putting it on steroids. Can't put it any other way. Right? I could probably process 3, 4, 5 steps down on a game of chess or what I think the weather is going to be, but a computer could do 5, 6, 7,000 of these, right, all at once, and outthink us.
Accuracy, streamlining, processes. Today we're seeing, again, the use case historically, but I'm really fascinated by something Ben Carson shared at a conference a few years ago. The human capability of every human on Earth has the capacity to learn a new idea every second for the next 3 million years. We have a huge computer right up here, and we're using it. And we're using it to apply these innovations that are coming alive all around us. You look at ChatGPT. Everybody's talking about it. It's the rage. It's scanning everything in the universe of the internet. Every book, every file, every website, all the information. That's just an amazing idea. And then it's articulating it and processing it in a more formatted way based on structured information that it knows. But here's what it doesn't know. And this is why it gets all messed up. And this is why it can be dangerous if it's not used properly. It doesn't know necessarily the outcome that you're looking for. It will profess, based on a prompt, a question, what it might think you're asking for, and then come up with its own hypothesis on how to answer it. And this is why you can get into trouble with GBT, right? But it is being used, and how can it be used more? Oh my gosh, structure it. point it at a certain data corpus, and ask it a question. Whoa, that is useful. That is how it's going to be used in the future. And just prior to getting up here today, Janty and I were working on some of our responses and thinking about how do we best answer some of these questions. And I said, do me a favor. We wrote down our brain thoughts on how we would respond to the questions. And then I said, watch this. I put it into GPT. It was uncanny how closely related to exactly what we responded to in our own writing. It hit it. So, as we look at, and that's just one example. I mean, we're talking about mortgage underwriting. We're talking about how can it help you in the audience today, and how is predictive analytics, truly being applied in the world, and what's the world going to look like? People are fearing their jobs, because GPT can do it. Yeah, but it can't. It can't. It can't know, truly what we're thinking and how we want to help that consumer. It can know what the world says about it from historical purposes, but it may not know precisely, whether you qualify for a loan. So we've got to feed it, we've got to train it, we've got to understand it, and we've got to make sure we protect, the real integrity of the people using these technologies. We can't allow it to introduce bias. We can't allow it to segregate the information in a way that it thinks best and ignore the true human. And so that's maybe jumping ahead a little bit.
Sure.
But I know, it can't predict what Tim's hair is going to look like next 6 months, right?
It's going to be long. It's going to be longer.
I mean, I saw him last week, and I was like, I know that guy. But last time I saw you, had a head buzz. But yeah, so it's cool. It's exciting. I mean, it's going to open up new opportunities, and we've got to embrace it. It's the new world. It's the new world. And what that means is we can help a lot of people. We can apply it intelligently to origination systems, automation, to help the consumers come in and actually go through a process in less time than it takes to fax over a piece of paper. Wow, you could get a full underwrite.
Yeah, we look at that too, right? It's going to help you originate more effectively, lower your costs, et cetera, et cetera. But the thing that I always struck with you is the mission purpose behind it.
Yeah.
It's helping people get into homes, great, but helping people stay in homes. And I think we're going to talk about that a little bit later. But that's just where my head goes, right? If we can help understand, if you do this, you may not have a home in 5 years. You do this, you're not going to be able to maintain, pay for that new roof.
Yeah.
Right? If we can help consumers, and I think that's the real value of this. I think you hit around the nose. It's, yes, we'll make more money, we'll be more effective, we'll work a little bit less, hopefully. But can we actually help others with this data, with these tools? And I think the answer is yes. But it does take a community.
Yeah.
There's bad actors right now, building, training it to do some very bad things. But we're here for the good, and we got to stay focused on it.
So let's talk about two of the biggest challenges that the industry has, and we'll talk about one at a time here. Black Knight was here on the stage just before us talking about the cost of production of loans, right? And that's been a constant problem in the industry for last several decades, not just last several years. We have had technological evolutions. I mean, the technology that we use now is probably significantly better than we used to do for mortgage production just a decade back. And if you look at the cost of production, it hasn't really moved the needle on it. And we have had predictive analytics around credit reports, as you mentioned, and fraud guard and everything else. Where do you see the predictive analytics going next to actually move the needle on cost of production? Where can we get super lift on efficiencies? Where can we get super lift on lower foreclosures, lower delinquencies? How do you see industry actually using predictive analytics, say in the next 2 to 3 years, to handle that's one biggest problem? And I'll come to Brent and talk about the other big problem that the industry has now, which is about generating more credit-worthy customers. How do you go about doing that because of the lower production that we have? But talk to me about, Tim, is where do you see, especially with Be Smarty and everything else, how does predictive analytics, next gen of it, actually helps with lowering the production of a mortgage loan?
Yeah, that's a really loaded question because, you know, and as a CEO of a technology company, I'll say this, technology does not equal lower cost. It just doesn't. You can throw a lot of technology at stuff, and if you don't use it effectively, if it's not adaptive, it doesn't weave together, it's not orchestrated, you can make mistakes, it ends up being just more costly. Just ask my dad, right? He'd rather just pick up the phone and do it because getting through Google and figuring out the forms online, it's going to just take more time. It's not a good experience for him. But going, that with the foundation is, how does predictive analytics reduce? So when we break down the cost of a loan today, most IMBs are losing money on every loan, right? Gain on sale is negative. Negative carry is going on. You have lower compensation or higher LO comp, people cost. In fact, if you, there's another, the servicing, right? People are selling their servicing, right? They're not taking on because they want the cash now. So when we look at it from that lens, how do you bring costs down with predictive analytics? First, you got to start with the people. And I'm not by no means advocating eliminating jobs, but what I'm saying is helping people become more effective. Give you an example. I can't mention the name of the company. It was a big insurance company. They had this. They had a responsibility to fill up an arena, a bull riding arena in Texas. They hired a big marketing firm, threw a lot of money at it. The best they ever got was 25%. Well, about 3 years before that, they bought an AI company, and they trained it for marketing purposes. So they went back to the AI platform they built, and they used it as a way to how to write scripts, how to identify the target market, how to do where to advertise, who to advertise, when to advertise, which Instagram handles should be, we should be going after. And I kid you not, within 2 months, to execute that game plan, humans did, right? And they are now at 100% capacity.
Wow.
It's just one use case we're hearing. We hear a lot about this in the world. So when I think about predictive analytics and mortgage success, I think first we give it to the people, right? Can it help an originator more intelligently explain why this option is better than that option and the other option? Can it help present the data? Can it help communicate better, right? Enhancing human intelligence. I think it's the first step. And then there's operational stuff we can get into. Then there's retention stuff we can get into. But I want to pass over to Brent because he's got some good things we're doing at FormFree.
Yeah, Brent, I specifically really wanted to understand what is FormFree doing, and if you can kind of generalize it for the industry as well in terms of bringing more credit-worthy borrowers to the fold.
Yeah.
And how is that? What are you doing, and what do you think the industry can work on?
Yeah, no, it's exciting. But before I do that, see, my predictive analytic wasn't as sharp as Tim's because I'm freezing up here. I don't know how many people are cold in here, but I didn't bring my analytic didn't give me the sweater indicator. And I think that's kind of like true to how the new world looks a little bit. Predictive analytics is still a new thing. But I would really think about it in a way that it's been here, it's evolving. We're evolving. We're constantly evolving. And part of the evolution process of FormFree has always been to understand a basic concept that everybody borrows money and everybody has an ability to pay some amount, and we can quantify that amount empirically, mathematically, verify it, certify it, and then deliver that. And we really set out to do that early days, 2007, when I founded the company, with the idea that we can tokenize this information. We can capture it in a single token that represents the rest of the story. And that token could facilitate the safety and security of the information rather than putting it out on the ether. So when we think about streamlining processes and we think about capturing better information about the consumer, it really comes down to knowing the source. And this is where blockchain really becomes really powerful, right? Source data is really the foundation of the information that is linking together with every transaction in a transparent, safe, and secure way. That's the kind of the big definition of a token. So we've applied that information, that idea over the last decade to understanding a human's financial DNA. And the cool thing about that is, we're all representative of a picture, of a DNA type that truly represents like blood, who we are, how we behave, how we spend, how we save, how we, what's important to us. And that's not necessary for a lender or anyone else to know but me, but the amalgamation of that information can be assessed in nanoseconds and then interpreted using structured information outputs like standard accounting. Standard accounting would suggest that residual income is a better way to understand what I can afford. And if I can see the residual income and I can calculate it and I can validate it based on standard accounting practices without bias. Bias is a big deal. Bias cannot be involved in the accounting practices. Yeah. We're not trying to change the standard accounting that is accurate and true. It is truth. But what we can apply intelligence to is all the information that's coming in so we can understand it. This is where we actually created some new concepts around natural language generation from natural language processing and utilizing some forms of machine learning and artificial intelligence to actually understand the gobbledygook that comes out of banks. I mean, we have touch points of 48,000 financial institutions. You can imagine, USAA doesn't necessarily spit out a transaction like Bank of America, like Chase, or whomever. They all do it in their own kind of realm, in their own proprietary manner. And so deciphering that information is the trick. It's not interpreting what it's intending to be. It is the fact. It is the truth. So if we can understand those transactions at a very granular level, bring it into a natural language text where we can read it as a human, and then interpret that through standard accounting practices, you can actually understand a consumer's ability to pay. And that's what we've been doing. We've been applying this for over a decade. I just have to give a shout out to Dr. Michael Covington. He is a renowned artificial intelligence, natural language processor, machine learning expert in the world. Some of his sightings are he was the founder of the artificial intelligence school at the University of Georgia. He ran that for 30 years. He's also cited in Google's search parser by Sergey and Larry. But he's done things like stopped wars by interpreting behaviors from world leaders. So this is where it really becomes so fascinating when we can see an individual at a granular level and understand this person, regardless of the race, their gender, their socioeconomic background, can afford a loan. They can afford the loan. And we have 10.7 million people in this country today that qualify for a $300,000 loan in the demographics of Black and Hispanic households. But guess what they don't have? They don't have the right FICO.
Yeah.
We can't see them. We can't see them. So if I think about how can we apply technology to help the community, we can feed those opportunities to lenders, to banks, to credit unions. We can work together to identify these opportunities, feed it through an automated point of sale, stay with that consumer to stay in that home. How are they going to buy the refrigerator? We can look at discretionary spending. We can look at what they are spending on now and say, hey, you know what? Maybe we don't need to go to the casino every Friday, and try to hit the lotto. Yeah, these are the opportunities that are sitting right in front of us today. I mean, we see it. We see it right now. And that's our Ricky in a box. You can drop it in and lay it over an entire corpus of deposit accounts and identify those lead opportunities, you know? And we can expand the credit box. We can reach the underserved. Tony Thompson likes to say the not served. They've never been served. 84% of black Americans in this country have a 680 or lower FICO. They're not at the table. 64% have 620 or lower. We got to open the corpus. We got to open the aperture, expand the credit box, and you know who that helps? Not just the borrower who wants to get a house and build wealth in this country, because that's the best way to do it. It helps you guys and gals.
Yeah.
It helps lenders across the country. I mean, we're looking at 5 million units this year. It's down from 6 million last year. We're looking at another down year, and we're going to wait on a refi. We're going to wait on an interest rate. No, man. If you're a first-time home buyer and you've been renting for 10 years, and you can qualify, you can afford that mortgage rate at 7%. Look, if I don't know what 3% feels like because I never had it, I'm not really caring about what the rate is. And I know that sounds a little bit, different than what we hear about interest rates. But if I'm looking at that new home, I'm looking at a home because I'm ready to get in a home and raise my kids and really take care of something that I'm proud of, right? And build a family. And I want to stay in the home, so I need somebody to monitor that. But effectively, it's time that we help these people get into homes and stay in the homes. It's time to use the predictive analytics that we have available to us today, because it's a new world. We're not going backwards. You can't put this Pandora back in the box. It's happening right now.
Sure. Yeah, that's...
I went a little long, I'm sorry.
No, that's... So we talked about really the three phases of loan journey that you see. Brent talked about the fact of creating more borrowers. How do you do that? What are they doing it form-free? We talked about predictive analytics helping us reduce the cost of the production itself. For the final question, I really wanted to get to post-close. And what are we doing in terms of retention? I mean, whichever research or survey that you're reading, retention rate in the industry is from high single digits to very low double digits. We're looking at anything between 8 and 18%. And one of the challenges with post-closing has been just the generalization of marketing that we have seen, right? Post-closing, typically most lenders would be sending out newsletters talking about, hey, change your air filter every 6 months, change your whatever, clean your gutters every 2 years. And I think the consumers have moved from that information disparity that they had before, which is, oh, the lenders know so much more than I do as a borrower, to a stage where we have kind of come to an information parity, where a lot of our borrowers and homeowners know as much as a lot of lenders when it comes to, say, general maintenance of homes or other stuff. What are you seeing or what are the opportunities that you see, Tim, in terms of post-closing, where, say, these lenders can go from this generalization approach that they have to post-closing retention to more, say, personalization or even hyper-personalization, which is where I think the future is if you're looking to retain more of your clients.
So that's Be Smart 2.0 sometime in the future that we're starting to work on. You know, our belief is if you want customers to come back to you, first off, you got to serve them well through that process.
Of course.
And you got to build trust throughout the life of the loan. And we have a saying at Be Smart we call it 0-30. Right? Most people get into a 30-year loan, and you might spend, as an originator, 3, 4, 5, 6 months with a borrower buying their first home. So the time you spend with them as a lender is less than 1, hence the 0.
Yeah.
But you're putting them in a product that's 30. But do lenders actually talk to the borrowers about what their life of the loan ownership actually looks like? And that's where I think the opportunity lays, because think about yourself buying your first home. You have a lot of questions. Who do you go to? Mom and dad. Aunt and uncle, right? You go there first. Should I get this loan? Is it the right deal? Is it a good deal? And then after that, who does the first-time home buyer go to? Again, mom and dad, aunts and uncles, right? Family members who've been there before, because there's trust. Hey, what should I do with my roof? What's quotes better? Should I stock away $50 every month for X, Y, and Z? Mm-hmm. Should I remodel this, right? These are questions going through their minds. But the lender's nowhere around. Happy birthday, cool. General recipes or neighborhood events, cool. But we got to go way beyond that. We got to actually want to help them stay in that home
Yes.
and build that trust. And if you do that, I think we'll break the cycle of what 1 in 5 borrowers will go back to the original lender that they bought with originally. That trend's got to be broken if we want to see a lower cost of reacquisition.
Cool. I see that we have come to the end of our time, so thank you for staying with us. Thank you to our panelists, Tim and Brent, for joining us today. I hope you enjoyed our conversation about predictive analytics, machine learning, client retention, when we got into a lot of different things in the last 28, 29 minutes. But thank you for staying here, and have a great rest of the afternoon.
Thank you.